Okay, hi everyone. Good evening. We'll start the webinar now. So I'm Pei Ling and welcome to tonight's webinar. Before we dive in, just a quick heads up. Everything that is shared during this session is purely for educational purpose and reflects the speaker's personal views. It's not meant to be taken as trading or investment advice. If you have any questions during this session, feel free to pop them in the Q&A box in Zoom. You can also upvote questions you are curious about. That way we'll know which ones are the more popular ones, so our speaker can actually address them. Tonight's webinar is actually a part 2 of our 3-part SG Market series in collaboration with XGX. We'll be exploring insights into trading Singapore stocks. Okay, the theme for this evening is actually navigating market trends in the Q3 2025, opportunities and risks ahead. Before we start, I'd like to quickly share about an exciting lucky draw campaign that we are currently running with SGX. So let me just share the screen with you. It is actually our campaign page from our campaign page. You can also navigate from here under latest insight under campaigns. So this SGX trading campaign, you get to win prizes when you trade on the SGX market. So this campaign actually started back in 1st June last 2 months, and will be ending on 30th September. So if you execute any buy or sell trades on the SGX market itself, you will actually get a ticket chance. So for any buy or sell, you get 1 ticket each. Okay, for selected SGX listed stocks and ETFs over here, you can actually get 2 entry ticket chance. So today is actually our July draw, meaning tabulating our draw entry tickets from 1st July until 31st July for the whole month. So this lucky draw will happen at the end of this webinar itself. For some of you who are not sure of what are the listed selected ETFs and stocks that get 2 ticket chance, you can actually find it under here. And if you want to find out more about the terms and conditions of this lucky draw, you can also click over here. All right. So before now I will just hand things over to Xun Xiang for Lion Global Investors, who is here to share more with us. Xun Xiang, over to you.
Hey, thank you, Pei Ling, for sharing about this wonderful lucky draw. And it's so great that today I'll be presenting about our ETFs together with a lucky draw campaign. And good evening, everyone. Thank you for joining us today. I'm Xun Xiang from Lion Global Investors. If you find my name too difficult to pronounce or remember, just remember me as the ETF guy of LGI. So it's easier to remember and recall. So today I'll be sharing about 3 key ETFs within our offering. First will be the Singapore Low Carbon ETF. That has been the ETF that has consistently outperformed the STI since its inception in 28 April in 2022. The second ETF I'll be talking about will be our APAC Financials ETF. So regarding this ETF, it's the world's first APAC Financials ETF, and it offers 5% per annum quarterly distribution. And the final ETF I will later talk about will be our Japan Active ETF. Right now, it's still Singapore's first and only active ETF. So this ETF has been the 3rd best performing ETF and also best performing Japan equities ETF on the whole of SGX in the first half of this year. So these will be the 3 ETFs I'll talk about. So the first one I will start with will be our Singapore Low Carbon ETF. So regarding our Singapore Low Carbon ETF, basically the key thing to remember is that since its inception and listing on the 28th of April in 2022, it has consistently outperformed the Straits Times Index. So it has been listed for more than 3 years already. And right now, it has still consistently been outperforming the STI. So as the STI hits new record highs, our ETF has also been continuously hitting new price highs, demonstrating the momentum, but also at the same time presenting a different outlook and overview to the Singapore market. Because the STI so far has been mainly focused on the 3 key financials, 3 key banks within Singapore, but less focus on Singapore companies that are listed outside Singapore. So this is the ETF that captures it. And before I dive deep into these three ETFs, maybe I'll also give a brief introduction about Lion Global Investors, in case some of you don't understand or recall who we are. So we are part of OCBC Group and one of Southeast Asia's largest asset managers. So today our total AUM is around 75 billion Sing dollars, and a lot of our assets are mainly from strategic and also key investors. So made up of many different investments that have accumulated over the years. And our stronghold is within Singapore. We are headquartered in Singapore. So because of this, we built products mainly for the Singapore market to cater to Singapore flavor. And these are our key ETF offerings. We started our ETF business back in 2017 when we launched our first ETF, which is the Lion Philippe S-REIT ETF. Today, it is the largest REIT ETF and also one of the most liquid REIT ETFs on the SGX. And since then, we significantly started growing the business, starting in 2020 when we launched our Hang Seng Tech ETF back in December 2020. So this is when actually we significantly propelled the business. So our Hang Seng Tech ETF today is still the top traded among the top traded ETF by trading volume, and was the top traded ETF in terms of trading volume for the past 3 years. So right now it still continues this momentum. And between 2020 to 2022, we listed basically 3 ETFs within 18 months. So one of it also includes the China Leaders ETF, which includes 80 constituents that are representative of the Chinese market, basically 80 industry leaders within China. And then after that, one of it will be our Singapore Low Carbon ETF, which we listed in April 2022. It was Singapore's first low carbon ETF back then. And it has been among the top performing Singapore equities ETF since then. So basically, two key things about this ETF, other than significantly and consistently outperforming the STI since 2022. It also was the top dividend-paying Singapore equities ETF last year, and also the top performing sustainability-linked ETF on the SGX in 2024. And after that, after 2022, within 2024, which was just last year, we listed 3 ETFs within 1 year. So one of the ETFs we listed back in 2024, the first one was actually on the Japan Active ETF, which was Singapore's first active ETF. Right now, it's still the only active ETF, which gives investors exposure to the Japan equities market and aims to outperform topics. And glad to share that for the past 12 months or 1 year, we have consistently also been outperforming the topics. So right now, it means the best performing Japan equities ETF listed on the SGX. And also in 2024, we listed the APAC Financials ETF, which is also one of the ETFs I'll cover later. Basically, it offers 5% per annum quarterly distribution. And then after, we also listed our Emerging Asia ETF back in December, and also earlier in March this year, listed the Lion China Merchants CSI Dividend ETF. So in terms of this is basically a snapshot in terms of our total ETF journey. Right now, we have 8 ETFs, and we will be launching more ETFs in the next few months. So stay tuned for all these. And with this, we have built ourselves together with the business, with everyone's help, to become the ETF issuer with the most number of ETFs on the SGX. So to talk about this ETF, basically these are the 4 key things to remember or understand. So first, it was the top dividend-paying ETF in terms of top dividend-paying Singapore equities ETF last year, and also top performing sustainability-linked ETF last year. And all these actually bring a lot of returns for investors if we even add on the special distributions which we have given last year to help investors lock in capital gains. So our ETFs so far, they have been among the top 10 ETFs held by retail investors. You can see our S-REIT ETF and Hang Seng Tech ETF being ranked among the top 10 among retail investors like all of us, including myself. And in terms of SRS investors, they are also ranked within the top 10. And if we look in terms of trading volume, we are also ranked within the top 10 ETFs back in 2024, which was the whole of last year. And we continue to be among the top 10 for a lot of our ETFs, even within 30th of June 2025, based on the latest SGX figures. So for the Singapore low carbon ETF, the Singapore story is a very bright and also important story, especially with SG16 approaching this weekend. And the fact that Singapore, despite all the various challenges which we have overcome, we continue to want to scale new heights and grow new heights. And with all these happening actually for the green and climate change, climate change issues which impacts everyone within the world, it is important. And that's why actually DPM Lawrence Wong back then in 2022, and now he's the PM, pledged and committed that Singapore should commit and also commit ourselves to net zero by 2050. And the key fact is that although Singapore will only account for 0.1% of the global emissions, we want to do our part to tackle the global issue of climate change. And so with all this, and also with SG60 approaching, Singapore should not only just be known as a little red dot, because we are also a little green dot, which aims to shine and also help the world tackle this global issue of climate change. And with PM Lawrence Wong also back then already highlighting the importance of tackling climate change, all these have cascaded downwards to a lot of stat boards and government agencies. So for example, this year, which is a significant year, Singapore already committed to reduce its greenhouse gas emissions to around 50 million tons. And this is actually a more aggressive target compared to what was set previously. And we are on track to achieve net zero by 2050. So in fact, from EDB, Singapore actually mentioned and reinforced the importance of sustainability concerns in attracting investments. So all these are important to help the country also accumulate and also embrace greater sustainability towards a lower carbon footprint. Okay. Okay, and in fact, back in the few years ago, which was I think back in 2023, all of us together with between SGX, OCBC, Securities, and also LGI, came together on an event to be able to plant trees, to plant trees and contribute to the 1 million trees movement. And all these demonstrate that we walk the talk to be able to do our part to tackle climate change. So investments sometimes is not just purely about achieving returns, which this ETF has achieved, but also at the same time doing our part to be able to tackle the global issue of climate change. And in terms of why the ETF, basically the key thing is that this ETF has significantly and also consistently outperformed the Straits Times Index, which is Singapore's national benchmark, since 2022 April. And last year we have consistently done so. This year so far, in terms of annualized return, we have consistently been able to beat the STI in terms of cumulative return and on an annualized basis, consistently beat the STI every year. So all these give greater comfort, and there are a few reasons why we were able to do so. First is because of sector diversification, where diversification is actually one of the broad pillars within the seminars theme. And in terms of sector diversification, you will notice that from the chart here that STI is significantly concentrated within the three local banks. But compared to the STI, we offer greater diversification across sectors by lowering weightage towards the financial sector, but also increasing weightage towards real estate sector, which has recently done well within the past year. And also at the same time, greater weightage towards technology. So this weightage towards technology is important because it helps modernize and cover the more modern areas of the Singapore economy. So we include different constituents that are listed outside Singapore, but actually domiciled and headquartered within Singapore. So one key example is actually C Limited. The other one is actually Grab Limited. So we cover a lot of these growth companies together with value companies within this ETF. The next one is actually in terms of geographical diversification. So in terms of geographical diversification, you will notice that this ETF covers constituents that are listed outside of Singapore. So it covers US listed constituents together with Hong Kong listed constituents. So you notice that if we zoom into all the constituents, these are the top few constituents within this ETF. You notice that actually so far DBS only returned around 6%, and the two other banks actually returned below 5% this year so far. But if we look at the other constituents that are listed outside Singapore, for example, like C Limited, last year they grew more than 1 times by 170%. This year it has also returned 40%. And similarly, we have greater weightage within constituents like Singtel, which has done well in the past 2 years, together with other different constituents, to be able to add greater geographical diversification, while at the same time bring this growth element within this ETF, which is something the STI, which being a traditional index, which was incorporated back in the 1960s, hasn't incorporated within, which the STI hasn't really incorporated within so far. And this because we follow this index methodology, which is created by the SGX to be representative of Singapore's real and financial economy. So I think in terms of the key rules that are involved in this index, one key one would be in terms of liquidity, to ensure the constituents inside are liquid enough, and also at the same time because we also screen for carbon emissions, and the key carbon emissions we screen for is in terms of carbon intensity, which is the carbon emissions per $1 million of revenue, and this is what we move the bottom top 10, the bottom 10% with the highest carbon intensity. So those that emit a lot of carbon per $1 million of revenue, and choose after that from this the top 40 constituents by free float market cap to be able to form this index. So because of this, the constituents within the index, most of them, they are large cap companies. They also include the different Singapore REITs, but at the same time, there are those that emit little carbon in terms of emissions, and these are the companies that also take action to be able to reduce that carbon footprint. And all these actually, as a result, help to position these companies well for long-term growth. And this is what the index and also the ETF is about representing Singapore's real and financial economy. So in the early part of this year, which is in Q1, we actually did index enhancement to be able to further align this index with the global sustainability practices. And because we managed to be able to get more data in terms of the carbon emissions, that's why we include more scope 3 emissions within the index methodology to be able to after that further adjust the constituents weights accordingly because of this. And all these in the end helps the index become more robust in selecting good companies that emit low carbon, but at the same time still retain the proper and also good growth potential for the respective constituents. So as a result, what you see is that this index in terms of carbon emissions per $1 million revenue, it has the lowest, which is below 30, compared to the MSCI Singapore, which we are actually more than 4 times or 5 times lower, and we are also around 4 times lower compared to the STI. So at the same time, although we emit lower carbon, our returns have been consistently outperforming the STI. So these are the top 20 constituents of this ETF.
Sorry,
And
sorry to interrupt. Your screen is not moving. Could
my screen is not moving.
Yes.
Okay.
The shared screen is still stuck at the
Okay.
Apologies.
I think okay. Is it showing now?
Yes, it is showing now.
Okay, so these are the top. Actually, where did the screen freeze at previously?
The EDB.
Oh no. Okay, so I
Yeah.
did. All right. Okay. All right. So these are the top 20 constituents of the ETF. You will notice the three local banks, they are within this ETF, and also at the same time, there are a lot of dividend yielding companies within the ETF. So you will notice a lot of Singapore REITs that will stand to benefit when there will be further rate cuts within the next few months. So all these will help propel the ETF forward in terms of growth potential, while at the same time also help support the ETF's distributions in terms of the semi-annual dividends. And last year, in fact, we already made a special distribution of 3 cents per unit. So all these are important to be able to help further enhance the dividend yield back to the investor's pocket. So all these are what we do to be able to help lock in capital gains for investors, while at the same time ensuring proper income in terms of the dividend yield for this ETF. So I'll skip some of the slides because there are two more ETFs to cover. So in short, this ETF is important and also has been outperforming the STI consistently on an annualized basis. It tracks the IHOCBC Singapore Low Carbon Select 40 Capped Index. It has 40 constituents inside. The three local banks are among the top constituents, and also it pays a dividend yield of more than 5.7% so far, based on the latest Bloomberg figures. The SGX tickers are ESG for the Sing dollar counter and ESU for the US dollar counter. So we hope you consider this as a ETF to invest in, and also stand the chance to win a lucky draw item from CGS. So, okay, this is the first. So the second ETF I will cover will be the APAC Financials ETF. Basically, the key point is 5% per annum quarterly distribution. And in terms of the 5% per annum quarterly distribution, we have consistently paid out these quarterly distributions of 1.25 cents, consistently paid out since the listing on 13th of May in 2024. And in fact, last month, we just announced another special distribution of 3 cents per unit. So this is, in fact, the second special distribution we have announced for this ETF. This ETF is also one of the top performing ETFs on the SGX in the first half of this year, and has consistently been able to pay good dividends. So last year, if we in fact include the 3% special distribution made together with the 1.25%, which we made for 3 quarters, the distribution yield was around 6%. This year, we have already consistently paid out 1.25% in each quarter, and we already announced and we are paying the special distribution tomorrow for the 3 cents per unit. So there could be a possibility where the dividend yield could even exceed 6 or 7% for this ETF based on all the distributions we have returned and paid out to investors. So the ETF is interesting in the sense that it focuses on the financial sector, which is not just about banks, but also about companies that incorporate investment management, insurance, and also brokerages. Because of this, it covers the entire financial ecosystem. And all these are important because they help to smoothen the flow of capital, investments, and insurance to enable economies to trade globally. And you will notice that the ETF's name is APAC Financials Dividend Plus ETF. So in terms of the plus, there are a few catalysts with that is worth mentioning for the ETF. The first is about in terms of cushion profitability. So for the past few years, the banks have posted record high profits, decade high profits, and also return on equity. In fact, even if we look at the recent earnings announcement, even by DBS, they have continued to hit record high profits for the respective quarters. And all these is not just powered, in the past they were powered by the interest rate hikes. And right now they are being powered by the possibility of rate cuts, because whenever there's interest rate cuts, the capital is actually further redirected by investors towards investment products or wealth management products. So this is where actually all these wealth management fee income actually further increases within the financial institutions. And whenever these financial institutions are more well capitalized, they are also more likely to maintain profitability. And another catalyst is also for a lot of financial institutions, they are tilting towards Asia. And in fact, more than there are going to be more and more banks joining the top global 100 banks in the next decade. So all these are important to further catalyze the growth of APAC financial institutions. And third is about the pivot towards capital light models, because they use much less in terms of the bank's balance sheet or the financial institution's balance sheet, but actually bring better income. So key example is the use or embracement of digital transformation, especially AI, to become capital light. And whenever there are digital customers, digital infrastructure, all these actually help to reduce a lot of fixed costs and also spread out the unit fixed costs remaining over different investors. So and ensure greater profitability per client for the different financial institutions. So all these are important to help improve the profitability of APAC financial institutions. So right now, if we just compare to the STI for this ETFs index, it's trading at a similar price to earnings ratio. But in terms of the price to book ratio, it's trading significantly lower at around 1.3. And all these are because these catalysts are long term and they take time to be priced in for the market. And there have been a lot of talks about what if rate cuts happen? How would this impact the APAC financials? Because the natural thought is that whenever there are rate cuts, it could reduce or dilute the net interest margins. But as I also shared earlier, the financial sector is actually an ecosystem with different businesses that react differently with varying reactions towards rate cuts. So whenever there are actually expectations of rate cuts, all these can drive investment activity, especially in APAC, directing capital towards wealth management products and also insurance products. So for example, in DBS alone, they have hit record high profits for wealth management fee incomes, which actually grew by 35% within Q1. And a lot of the banks back then already started protecting their net interest margins. Other than there are a few ways they did so. First, they have been cutting the savings accounts interest rates, while at the same time still maintaining a good loan interest rate income. And another way is actually increasing positions towards longer term fixed rate assets, so to be able to capture and lock in higher yields. So, so all these have been what the sophisticated banks have been doing to protect their interest income. And compared to just purely buying the three local banks, what these ETF offers is actually geographical diversification, because it covers constituents that are in countries at different stages of the interest rate cycle. So, for example, we have been a lot of the parts of the world have been embracing or bracing themselves for US rate cuts. But there's been actually a country that isn't really bracing for rate cuts, but in fact, it might be bracing for rate hikes. And this country is actually Japan. And so much so that the one in Japan, one of the largest financial institutions, which is Sumitomo Mitsui Financial Group, the group CEO actually mentioned that they actually set an ambitious target of 100 billion yen profit in 2024, and they already continued to be able to achieve it and achieve new revenue and profitability milestones. So in fact, they already further revised their target upward by another 100 billion in November, and also eventually they outperformed their target profit. So all these actually are important to demonstrate that the importance of geographical diversification, because although some parts of the world they might not react well towards rate cuts, there are other parts of the world that could react well to rate cuts or even rate hikes of the different countries. So all these demonstrate two key facts. One is that the financial sector is an ecosystem diversified across businesses. And another fact is that it's also diversified across geographies. So all these are important to help the financial sector sustain itself throughout centuries, and also at the same time continue allowing it to pay good dividends to the end investors. So the ETFs index basically consists of 30 constituents. They consist of the 30 largest and most tradable APAC financial institutions. So you notice there's a key criteria, which is the minimum 2-year average dividend yield threshold. So we set this minimum average dividend yield threshold to ensure that the constituents that are eventually included within the index, they have been paying good dividends over the past 2 years. So it's to ensure sustainable dividend payout track record. And the constituents also have to have a minimum market cap of $1 billion. And a lot of times the constituents, because a lot of them inside the index, they are large cap constituents. So they easily can meet this 1 billion market cap threshold. There's also a 7% single stock weightage cap and also 20% country weightage cap to ensure we spread out the index and diversify across different indices. So these are the three key features of this ETF. Basically, it helps investors focus on income and growth. So focus on the top 30 largest and most tradable APAC financial institutions. In terms of income, 5% per annum quarterly distribution. And also in terms of growth, providing exposure to potential capital appreciation in the APAC financial sector. And since the listing in 13th of May in 2024, the ETF has performed around 26% in terms of it has performed for 26%, grown by 26% since its listing. And so far in this year, it has returned more than 11% already. And this is still excluding the distributions which we have still made out to investors. So it has performed very, very well since its listing is one of the top performing ETFs on the SGX. And in terms of portfolio characteristics, you will notice the well spread in terms of geographical diversification. Singapore is below 20%, but you will notice there are other countries that are represented within this ETF, and these companies that have grown well in terms of price levels, and also at the same time still paid good dividends. So some example will be Japan, in terms of Australia and also Korea. And these are the full portfolio holdings, the top 30, the full 30 constituents of this ETF. You'll notice our three local banks similarly are within the top few constituents. They are above 5%. But we also have Japanese banks and financial institutions inside, for example, like Mizuho, and also even Korean institutions like KB Financial, to be able to smoothen out and add this geographical diversification angle to investors. So in terms of the ETF's top performance of the top holdings, you notice that cumulatively since 13th of May in 2024, the three local banks, they have performed well at above 20%. But the Japanese banks actually have performed even better. So for example, like for Mizuho, it has performed around 38% since the ETF's inception. And we even look at the Australian banks, for example, like Commonwealth Bank, it has grown by 52% since the ETF's inception. So all these actually illustrate the importance of geographical diversification. So we don't just focus on the Singapore market or look at purely at the the three local banks, and also look beyond other parts of Asia to seek greater growth, and also at the same time still are able to gain a sustainable dividend yield income for investors. So the key ticker for this ETF will be YLD, which basically stands for yield, and also YLU for the USD counter. So it is an avenue for investors like you and also myself to be able to earn stable dividends of 5% per annum quarterly distribution, and also a good avenue to gain geographical diversification across APEC's financial sector. So there's a summary of these two ETFs which I covered earlier. So basically, the Singapore Low Carbon ETF has 40 Singapore-domiciled companies. The 3 local banks are within the top 10 and top 5. Similarly, for APAC Financials, they are also within the top 5 constituents. And although there's this angle of these 3 local banks within the top 5, so all these add the sense of familiarity. At the same time, there's also this other aspect of providing geographical diversification. So you actually gain greater diversification across geographies to be able to include companies listed in other parts of the world, but at the same time still achieve dividend yields of above 5%. So this is what these two ETFs are about. These are the two income building blocks we have within LGI's ETF suite. So these are the two passive ETFs I've covered. So the third one I will talk about would be the Japan Active ETF. So basically for the Lion-Nomura Japan Active ETF, it is Singapore's first active ETF and also Singapore's first AI-powered ETF. So this ETF is actually powered by the AI algorithms of both Lion Global Investors together with Nomura Asset Management, and is actively managed. So there's the monthly rebalance that happens within this ETF to ensure it reacts to market changes. But at the same time, we only focus on the Japan equities market. So there's this. So the investment universe is purely on the Japan equities market, and all these actually help the AI to be able to pick out the hidden gems within the large Japan equities market, which I will share about a lot more about later. So in terms of I'll just briefly and run through the key things about Japan. So for Japan, there are 3 key growth catalysts. First is on corporate governance reforms, which are continuously happening. So all these are important to drive long-term structural change. So it started back in Japan's late PM, which is Shinzo Abe, and all these have driven a lot of structural change within Japan. So the key changes were implemented by the Tokyo Stock Exchange when they restructured the market segments. And then after that, having this rule that directs that if companies trade below price book 1, they have to comply or explain. So all these have been important in the past few years to trigger more share buybacks and also dividend payouts for the Japan equities market. So all these actually help the small mid caps grow more and more within Japan and also benefit from these corporate governance reforms, because a lot of them were trading below price book 1, and they are slowly inching towards trading greater than price book 1. And the second catalyst within Japan is actually inflation, which has been growing steadily over the years. Japan has increased wages for a lot of these different labor unions, and all these actually further trigger this virtuous cycle because there's greater consumption, and all these help to stimulate the economy within Japan. And within Japan, there was also a new scheme in terms of NISA, which is a bit like our SRS, where they reformed all these programs to increase the total lifetime investment cap. So all these have helped to unlock more purchases within Japan equities, and all these will continue to do so when more Japan individual investors further invest into the Japan equities market. So all these are important to help sustain Japan's growth within the next 5 years. And there have been also a lot of investors slowly reallocating towards Japan. The most famous investor that's invested and taken a large position in Japan is actually Warren Buffett, which has invested in five of the Sogo Soshas within Japan. And since then, there's been a lot of investor interest rising within Japan. And all these talks about increasing interest rates within Japan are also further uh, triggering this reallocation of funds towards Japanese markets. And with all these happening, all these are also helping to further increase movements towards the Japanese yen, which is actually correlated towards reduced foreign securities investments by Japan investment trusts. So this repatriation of funds are important to help provide this structural support for Japan equities. And within Japan, in terms of the different corporations, the fundamentals have also been improving. Net profit margins have steadily grown, and because of all the reforms, especially the corporate governance reforms, the Japan companies' balance sheet have actually been strengthened over the years. And all these have increased share buybacks to increase returns on equity and also further increase the stock prices of a lot of Japan equities. So that's why you have noticed that since we launched the ETF last year, there's been steady growth in terms of performance for this ETF. And topics has already been performing well, but we have been outperforming topics for the past 1 year because of all these, because of how we choose the different Japan equities, and also at the same time because of the improving corporate fundamentals in Japan that are driving stronger returns. So right now, if we look at the global landscape, Japan is actually still priced relatively attractive because the price to earnings is still at around 14. Price to book is at 1.4. But if we compare it with the US, which is trading at price to earnings of around 21 and also price to book around 5, Japan is at a relatively attractive entry point for accumulation right now. And in terms of the earnings growth, Japan is actually forecasted to have higher earnings growth compared to US and also compared to China. And all these are because the growth catalysts are long term and they take time to be priced in for Japan equities. And you'll notice that I also mentioned that this is the first and only active ETF within Singapore so far. In terms of active ETF, basically it means that because most ETFs are like the previous two I mentioned, they track an index, but an active ETF can be actively managed by a manager. And in this case, we actually use AI as the manager to be able to pick stocks, analyze stocks, and then after that, react accordingly to make investment decisions to benefit the fund. And as the AI becomes stronger and also smarter, all these investment decisions in terms of returns also further improve within the ETF. And within the active ETF segment, they have slowly been growing within the global landscape. Within US, they are a very popular trend. So for investors, if you are looking towards active ETFs, it is a growing trend globally. And eventually, within Asia, there will be more and more active ETFs that will be listed and also launched. So all these are a growing trend, which investors should be taking note of. Because of three key things, if we compare an active ETF with a passive ETF, also compare it with a mutual fund. So in terms of active ETF, there's intraday trading compared to a mutual fund that doesn't. There's only that only has once a day subscription and redemption. And compared to mutual funds, active ETFs are also more cost efficient. And if we compare it with a normal uh, passive ETF, it does not track a benchmark. So there's greater room to be able to outperform the broader market, like what this ETF did for the past 1 year in outperforming topics. So for this ETF, there are basically three key features. Is on AID, on how you aid your portfolio. So in terms of A, it focuses on the top 100 Japan equities with high capital appreciation potential. So in terms of I, the proprietary AI models, they work much faster than humans. They analyze hundreds of factors concurrently, and they are able to, compared to humans, continuously upgrade and refine themselves to make smarter and better investment decisions. In terms of D, it will be in terms of dynamic because the AI models are tweaked and improved every month to help respond to different investment trends dynamically and readily. So all these aid your portfolio. And this is why over the past 1 year, we have been able to outperform the topics, which is the broad Japan equities benchmark, recognized globally and also by the domestic investors within Japan. So basically, what we do in terms of this active ETF is to use the proprietary AI models of Lion Global Investors together with Nomura Asset Management. We use it to screen more than 2,000 or 3,000 Japan stocks that are listed on the different stock exchanges. And we also use a liquidity filter, so we only select the liquid Japanese stocks. And after that, there are the small cap, mid cap, and also large cap companies. The large cap companies usually are relatively well known because they have, for example, like Toyota, all these are the companies that have a lot of they are branded companies outside Japan. They have English financials. But the small and mid cap companies, they are those that mainly have Japanese financials. So for investors outside Japan, if we are limited by language barrier, we might not be able to analyze them. But because we use AI, we are able to in fact analyze some of them and also we work with Nomura Asset Management, which is Japan's largest ETF issuer. We work with them in terms of the AI model to be able to pick all these hidden gems within Japan. And in the end, we built this portfolio of 50 to 100 Japanese stocks and also apply different portfolio sizing to ensure the weight, the volatility, all these actually make sense for this portfolio. So far, we have been able to outperform topics. And this year alone, we have returned around 12%. It's one of the top performing ETFs on the SGX and the best performing Japan equities ETF on the SGX. So in terms of the sector coverage, there's huge diversification across different sectors. Right now, we maintain high weightage within consumer staples, which tend to be the defensive stocks, together with financials. So because key thing is Japanese financials have done really well over the past 1 to 2 years, which you already see in the APAC Financials ETF. The next is in terms of the spread across different market capitalizations. It consists of now 65% in terms of large caps and also around 33% in terms of the small mid cap companies, which have done well in the past few quarters to help the ETF boost its performance. So these are the top 20 constituents. You'll notice that a lot of them right now, they are the large cap companies because these large cap companies they are right now because in fact in the past few quarters you will notice actually some in the top 10 there are quite a few small mid caps, but because we are an active strategy, we notice that actually some of the large caps, they have become undervalued. Then after that we are able, because of this active strategy, we don't follow a fixed active strategy, and because it's AI powered, we are able to actually toggle between higher large cap weightage and also higher small mid cap weightage and not be fixed by strict rules. So all these actually are important to ensure flexibility of the ETF to be able to capture the opportunities to outperform the benchmark index, which we have done so for the past 1 year in outperforming topics. So for this ETF, it's Singapore's first active ETF. It's outperformed topics in the past 1 year. And the key tickers to remember will be JJJ, which stands for Japan, Japan, and Japan, and also JUS for the USD ticker. So it offers investors the smarter way to invest in Japan. So I've basically covered three key ETFs within our offering. The first is our Singapore low carbon ETF. The tickers are ESG and ESU. It has the key thing to remember, it has outperformed the Straits Times Index since its inception and listing in 2022. Second ETF I covered was the APAC Financials ETF. Key thing to remember is 5% per annum quarterly distribution. And the third ETF, which is this ETF I covered, it is the Lion Nomura Japan Active ETF. Key thing to remember, Singapore's first active ETF. It has outperformed topics in the past 1 year. So we hope you consider using them to gain greater geographical diversification and also at the same time use them as building blocks for your own portfolio. And at the side, also stand the chance to win different lucky draw prizes with the CGS campaign. So I'll pass the time back to Pei Ling for a while if you have any further things to share with the audience.
Thank you, Xun Xiang, for the insightful presentations. Okay, we have got some time now for Q&A. So for those who have joined late and miss out on the instruction, you can actually put down your Q&A under the Q&A box in Zoom. So Xun Xiang, let's answer some of the questions that we have. There's a question from Gabriel for the first carbon ETF. You mentioned that your benchmark is STI. However, based on your constituents, it looks like it's a bench should be based on MSCI Singapore instead. Comparing that to MSCI, does it still beat the benchmark?
Okay, I think the key thing about this ETF is you're right, Gabriel, that it is Singapore's first low carbon ETF. So the ETF tracks the benchmark of the ETF is the IHOCBC Singapore Low Carbon Select 40 Capped Index. So what we are comparing is actually with the other benchmarks that are within Singapore. The most well-known one is actually the Straits Times Index, which is why actually we compare it further with them. The MSCI Singapore is actually a much more concentrated index. So sometimes the volatility can be a lot higher compared to us, compared to our Singapore low carbon ETFs index. So that's why we are mainly comparing with the traditional benchmark, which is the Straits Times Index. And in terms of attributes, the Straits Times Index has 30 constituents, ours has 40 constituents. In terms of other attributes is that the Straits Times Index actually does not have a weightage cap. So because of this, that's why the three local banks that can occupy more than around 50% in terms of the index portfolio. But for ours, we apply a 8% weightage cap to be able to cap the different large cap constituents and ensure greater spread and diversification across sectors and also across geographies. So we can cover constituents that are listed outside Singapore and include Hong Kong listed and US listed constituents that have consistently been doing well over the past few years.
Okay, let's move on to the next question. So it's from Adi. Why these three ETF? I know Chinese team ETF since China is expected to be coming and up.
So you're right that to Adi that China is expected to be coming up and seems to be in the upcoming cycle. Because I have too many ETFs to cover, that I picked these three ETFs. But I'm more than happy to come back next time to talk about our China theme ETFs.
Yeah, thank you, Xun Xiang. I think that's all for the Q&A. I actually like to share my screen again for those of you who have joined late to share about our CGS SGX lucky draw campaign. Just hold on a minute. Let me share the screen. Okay, so for this SGX lucky draw campaign, for this month we're actually giving out like Apple MacBook, watches, LG monitor, and $50 cash credit to CGSI account traders, and then also $100 of worth of fair price vouchers. So this campaign started in 1st June and it will end on 30th September. So for today, at the following after this presentation, right, we'll be actually doing the lucky draw for the July draw. It's actually a tabulation of all your draw tickets that you have accumulated from 1st of July to 31st July. So how do you get these draw tickets? So if you execute buy or sell trade of $5,000 or more during this campaign period, you actually get one entry chance for each trade. And for those selected listed stocks or ETF, you get 2 entry chance. So all the ETF that Xun Xiang has actually shared just now are all eligible for 2 ticket entry chance. So you can trade, buy and close it, then you get 4 chances. Okay, so for that as well, if you want to see what are the other ongoing 2 ticket draw chance tickets, right, you can actually look for it over here. Yes, these are the list of it in Appendix B. So for the price itself, you can actually look for it here. So the next draw will be the August draw. We have same thing, like Apple and everything like that. So I will now proceed on to our July draw itself, using our pick wheeler, and we will notify the winners via email, or we'll reach out to your trading representative. So without further ado, we will do the lucky draw spin now, and we'll start off with the consolation prizes first. So we'll spin now. So congrats to Ying Tiong. So you'll be getting the $50 cash credits into your CGSI trading account. Let's give you a minute, it's hanging. Okay, the next one will also be the same. Okay, you'll be also getting the $50 cash credit into your account itself. Okay, Bohua, you'll also be getting the $50 cash credit into your account. Okay, the next one. Okay, Yichu will also be getting a $50 cash credit into his account. Ms. Hong also will be getting the $50 cash credit into their account. Okay, Picting will also get a $50 cash credit into their account. Okay, Old Tong will also get a $50 cash credit into their account. We will contact Archu as well to get a $50 cash credit into their account. And the last $50 cash credits will go to Huaike, will get $50 cash credit account also. Okay, so we move on to the 5 winners for the $100 Fair Price Group gift voucher. So next 5 will actually get $100 NTUC vouchers themselves. So we'll contact William for the $100 NTUC vouchers. We'll contact this for the $100 voucher. Ong Xun for the $100 NTUC voucher. Lion for the $100 NTUC voucher. And intro for the last $100 NTUC voucher. So now we are moving on to the third prize. Our third prize is actually the Apple AirPod Pro for our July draw. So it goes to Lei Chu. So we'll contact Lei Chu on how to redeem the prize. And the second prize is actually our Dyson wet and dry vacuum. It will go to Naryang, so we'll contact him as well. So for the first prize is actually our Samsung Galaxy S25 phone. Let's go. Okay, congratulations to Hunbu. So we'll contact you on how to redeem the prizes and reach out to you via emails. So here we come to the end of our webinar and presentation for today. Thank you, Xun Xiang, for his expertise in the ETFs and spending your time tonight with us. Okay, thank you. Thanks,
Thank you, everyone. Congrats for winning
Bye-bye.
your prizes.
Thank you. Bye-bye.
Thank you. Bye-bye.